two people. Same starting money, same 30 years. One bought stocks, one bought real estate, and the final numbers are this close. But here's the catch. That number you just saw for real estate, it's hiding something. Because one of these people only put in a fraction of the cash the other did. And once you understand why, you'll never look at this debate the same way again. So let's do the real math. No hype, no gurus, just the numbers. Stocks versus real estate. Who actually wins?
Meet Penny and Brick. Best friends. Same age, same job. And on the exact same day, they each get $60,000. Penny believes in the stock market. She's going to put her entire 60 grand into a simple S&P 500 index fund. Basically a tiny slice of the 500 biggest companies in America. And then do absolutely nothing. No trading, no checking, just let it sit for 30 years. Brick believes in real estate, but Brick is not going to buy a $60,000 property. Brick is going to do something clever and a little dangerous. He's going to use that 60 grand as a down payment to control a property worth way more than he could ever buy in cash. This is the single most important difference in the entire video, and we'll come back to it. But first, let's understand what each of them is actually betting on.
When Penny buys an index fund, she owns a piece of every major company. Apple, Microsoft, Coca-Cola, all of them. When they make money, she makes money. Two ways. The price goes up, and they pay her dividends, little cash payments just for holding. So what's the real number? Over the last 100 years, the U.S. stock market has returned about 10% per year on average, with dividends reinvested. But, and this matters, that's an average. Some years it's up 30%. Some years it crashes 40%. In 2008, people watched half their money vanish in months. The stock market doesn't reward smart. It rewards patient. The people who panic sold in 2008 locked in their losses. The people who did nothing, they got it all back, and then doubled it. So Penny's plan is simple. Invest, ignore, wait. After inflation, that 10% is really about 7% in actual buying power. Keep that 7% in your back pocket. It matters later.
The hardest part of Penny's strategy isn't the math. It's the discipline to do nothing for 30 years. Now, Brick. Here's where most people get the math completely wrong. If you just look at home prices, real estate looks weak. Historically, U.S. home prices have only gone up about 4% per year. After inflation, barely 1 to 1.5%. That's terrible compared to stocks. So how does anyone get rich in real estate? 4 hidden engines that home prices alone don't show you. Engine 1, leverage. Brick didn't pay $300,000. He put down $60,000 and borrowed the other $240,000 from the bank. But here's the magic. When his house goes up in value, he keeps all the gains, even on the bank's portion. Engine 2, rent. Brick doesn't live there. He rents it out. The tenant's rent pays the mortgage every month. Someone else is buying Brick a house. Engine 3, mortgage paydown. Every payment shrinks his loan. After 30 years, that $240,000 debt hits zero, and Brick owns the whole thing free and clear. Engine 4, tax advantages. Real estate comes with deductions and write-offs that stocks just don't get. This is why real estate investors talk about returns of 12, 15, even 25% a year. It's not the house going up 4%. It's 4 engines stacking on top of a borrowed pile of money.
Let me show you the exact math that breaks people's brains. Brick's house goes up just 5% in 1 year. On a $300,000 house, that's $15,000 in gains. But Brick only invested $60,000 of his own money. So that $15,000 gain isn't a 5% return on his cash, it's a 25% return. That's leverage. The house went up 5%, but because Brick controlled it with borrowed money, his actual return was 5 times bigger. Meanwhile, penny stocks would have needed to jump 25% in a single year to match that, and that almost never happens.
So real estate wins, right? Game over? Not so fast, because leverage is a double-edged sword. If that house drops 5%, Brick doesn't lose 5%. He loses 25% of his cash. Leverage multiplies your wins and your losses. Just ask anyone who bought property right before 2008. And there's more Brick has to deal with that Penny never will.
Here's what the real estate gurus conveniently skip. Brick has to be a landlord. Broken pipes at 3 a.m., tenants who don't pay, months where the place sits empty, and he covers the mortgage out of pocket. Property taxes, insurance, repairs, a new roof every couple decades. And if Brick suddenly needs his money, he can't. You can't sell a bedroom to cover an emergency. Selling a house takes months and costs thousands in fees.
Now look at Penny. Penny stocks need 0 phone calls, 0 repairs, 0 tenants. If she needs money, she sells in 2 seconds from her couch. No toilets, no roofs, no 3 a.m. emergencies. That's the trade-off the headline numbers hide. Real estate can pay more, but you work for it. Stocks pay a little less on average, but it's truly passive. So after all this, who actually wins the 30-year race? Let's run the real numbers.
Same starting point, $60,000 each, 30 years. Let's run it. Penny stocks. She invests $60,000 and earns the historical 10% per year. She never adds another dollar. After 30 years, about $872,000 from a single $60,000 investment. That's the power of compounding, doing nothing for a long time. Brick real estate. His $60,000 became a 20% down payment on a $300,000 property. Over 30 years, it appreciates at about 4% a year. His tenants pay off the entire mortgage. At the end, the property is worth around $973,000, and he owns it completely, debt-free, having only ever put in that original $60,000. The tenants bought him a $1 million asset. And that's before counting the rent that flowed into Brick's pocket each year once the mortgage was covered. On paper, Brick wins. But notice the asterisk. Brick's number assumes everything went right. Good tenants, no disasters, steady appreciation. Penny's number assumes she just existed. Two very different amounts of effort and risk for a surprisingly similar result.
So here's the real math, honestly. Stocks win on simplicity. Around 10% a year, completely passive, instantly accessible, and you never unclog a toilet. For 90% of people, this is the smarter, saner path to wealth. Real estate can win on raw returns, but only because of leverage. And leverage cuts both ways. You're taking on debt, risk, and a part-time job as a landlord to earn that extra edge. And here's the secret the wealthiest people already know. It was never actually versus. The richest investors don't pick one. They own index funds for the easy passive growth and real estate for the leverage and cash flow. The plus beats the versus every single time.
So the honest answer to which one will make you more money is the one you'll actually stick with for 30 years. Discipline beats strategy. Boring beats clever. Time beats timing. If this finally made the stocks versus real estate math click for you, hit subscribe. Every week I turn confusing money topics into simple stick-figure stories. If someone handed you 60 grand today, are you Team Penny or Team Brick? Drop it in the comments. I read every single one. See you in the next one.